Hi everyone, I'm Paul and welcome to my review of Lesson 12 of ICT's 2022 YouTube Mentorship Program. I've had lots of requests to do a review of Lesson 12 and so finally here it is. This lesson focuses specifically on ICT's market structure concepts and there's a ton of detail in it. I must have watched it about 10 times, so I hope I've captured all of the salient points and I've created a really valuable resource for you which you can watch many times over. So just a quick housekeeping point, I've been given access to the community tab on my channel. So thank you to everyone who's subscribed. I think you only get access after you've hit 500 subscribers. So I'll be posting there regularly. So make sure you check it out and leave a comment. Anyway, enough of the chit chat. Please like, subscribe and hit that notification button. Now let's jump into today's video. So today's video is lesson 12 of ICT's 2022 YouTube Mentorship Program. And we'll just start with the outline of today's video. So first we'll start with ICT's market structure concepts, then look at swing high and swing low patterns. So some of this is a review of topics we've covered in other lessons. And then we'll finish with a market structure example. So using the NASDAQ, using the daily 1 hour, 15 minute and 5 minute charts from around the 17th of February 2022. So if we start by just talking about ICT's market structure concepts, so ICT's specific method of observing market structure isn't probably what you're used to hearing. So traditionally you'd be taught about higher highs and higher lows and using those to either confirm or break trends or change in trends. And so this isn't like that. It's obviously similar, but it's quite different and there's a lot more detail. And so I think one of the key things of ICT's market structure concepts is that we use them to either confirm or negate an expected price move. Now, we don't have to go into too much detail about that now. That'll make a lot more sense as we start to go through some of those worked examples in the later part of the lesson. And so the important thing with market structure should always be used in conjunction with our bias from the daily chart. And so therefore, any charts on lower time frames are subservient to that daily chart. So there's this distinct parent-child relationship between the charts. And so obviously our daily chart where we spend the most time, and you should be spending the most time on your daily chart because this is the chart that universally nearly all traders use. And so this leads to another important point of bias, and then using obviously our bias in lower time frames, is it's important to think of this kind of like a tide or like a current. So we obviously want to be trading with that current. So we don't want to be going against the tide or against that trend because that's just going to make it much harder. And obviously in trading, if we're making it harder, it means we're reducing the probability of success of our trades. And so in terms of using our bias, we want that to flow from the higher time frames, so from the daily chart down to our lower time frames where we may be executing trades. And we want to be always working with the flow of that bias. And this is where our market structure helps us, because if we have a bias and we're trading directionally with that bias on the lower time frames, we're then going to use that market structure to either confirm or negate our hypothesis about that particular trade. So to dictate whether we go into it at all, or if we're already in a trade, to basically accept that we're probably going to be stopped out, or that we may close out earlier to minimize the loss on that trade, or that it's in fact going in our favor. And this is where these concepts all come together like layers to help us to create a trading model that we can use then in the markets. And so whenever we sit down in front of our chart, the question we're asking, and this is in terms of our bias, is if we're expecting high prices, so we're bullish, is price going to take out buy side liquidity or buy stops at a previous high, so it's going to go higher up to that point? Or is price going to trade up to a imbalance? So it's going to rebalance that imbalance or that bearish fair value gap. And conversely, if we're bearish, is price going to take out sell side liquidity or sell stops at previous lows? Or is price going to go down and rebalance an imbalance or a bullish fair value gap? And so this is the fundamental question that we're trying to answer whenever we sit down in front of our charts and determine our bias is where is price going to go? And these are, I guess, the decision trees that we use to make that determination, and we start to build our hypothesis on that basis. And so the thing we need to remember is just because we have a specific bias, it doesn't mean that price is going to immediately conform to that bias and deliver in the way we expect. And this is why market structure is important. So we're using market structure, as I touched on before, as a means of proving or disproving the hypothesis that we're starting to build on what we think price is going to do. And so another way I think of thinking of this is like we're telling a story, or you might think of it as a piece of code, like a true or false statement. So we need certain things to happen, and we need to see certain things for our hypothesis to be correct. And if we don't see those things, that means our hypothesis isn't correct. But just because our hypothesis isn't correct, it doesn't mean that the model doesn't work. It just means in this particular time, in this particular trade, that we're not correct, we're not going to be profitable. And so the story isn't going to play out as we'd anticipated. And so this is why market structure is so important, because it tells us where we're going to be wrong and where we're going to be right. And so this is why it's not only helpful but important, is because it dictates whether we're going to go into a trade and then how we're going to manage a position if we're actually in it, because basically the market structure is going to indicate that we're wrong, or it's going to tip its hand to us to give us an indication of where price might go and what specific direction it might go. And so that's helpful either for closing out a trade early, or if we're in a trade that's successful, it helps us to determine how we're going to manage that trade, where we're going to take profits, and how we're going to scale out. And so just some quick revision on swing high and swing low patterns. So we've covered this in previous lessons, but this is an important thing to just remember as we go in and start to talk more about market structure. So we have both swing high and swing low patterns. And so both of these are 3 candle formations. And so with a swing low, we have 3 candles, and the middle candle, the low of that candle needs to be lower than the low of the candles each side of it. And so with a swing high pattern, it's just the reverse of our swing low. So again, it's a 3 candle pattern, but the high of that center candle needs to be higher than the highs of the candles either side of it. And so with our swing high and swing low patterns, we can classify them in 3 ways on each side. So we can have a long-term high, and we're just using the abbreviations of LTH, intermediate term high, ITH, short-term high, STH, and then for our lows, we have a long-term low, LTL, an intermediate term low, ITL, and a short-term low, STL. And so you'll see I'll mark up charts using those abbreviations just to save a bit of space. So this is new information that we're now building on from the previous lessons about swing high and swing low patterns. And these things I'll go over in the worked example towards the end of the video, but it's important to start thinking about these now. So our long-term highs and our long-term lows, the important things about those particular swing high and swing low patterns is they're anchored to the daily time frame. So they're anchored to that higher time frame, and therefore they're going to be important about how we're formulating our bias. And so that might be linked to a specific point in the market, like a fair value gap or some other formation. But the important part is that they link to the daily time frame, and that's going to help us quite early to determine if our hypothesis is either correct or incorrect, because price has taken out one of those long-term highs or long-term lows, and that's not what we were wanting in terms of the formation of our, our story, for want of a better word. So the next swing high and swing low patterns we want to talk about is the intermediate term highs or the intermediate term lows. Now there's 2 distinct ways that these are created, and the traditional way is when there's a either swing high or swing low either side of that intermediate high or low. So if you think about an intermediate term low, so the low of that intermediate term low should be lower than the 2 swing lows either side of it. So both the left and the right should be short-term lows. Now that might be a bit confusing, but it'll make more sense when you see it on the chart. And obviously the converse is true for an intermediate term high. The intermediate term high will be a swing high pattern between 2 short-term highs. And so there'll be a short-term high to the left and to the right of that intermediate term high. And the high of the intermediate term high should be higher than the 2 highs either side of it. And so the other way an intermediate term high or intermediate term low can be created is when price fills in a bullish or a bearish imbalance. So when we're filling in one of those fair value gaps, whenever that happens, either the high or the low that's created at that point immediately becomes an intermediate term high or an intermediate term low. And this is where ICT's concepts of market structure start to deviate quite quickly away from others, is because no one else really uses fair value gaps. This is a distinct point of difference ICT has over other, viewpoints on market structure. So don't worry if that's a little bit confusing. If you're trying to imagine that in your mind's eye, it'll make much more sense as we go through that worked example, and I'll spend a little bit of time on those as we go through. So moving on now to our worked example on market structure using the daily chart on the NASDAQ as our starting point. So as always, when we sit down in front of our charts, from the moment we sit down, we're trying to determine what our bias is. And so you'll remember from earlier in the video, we talked about in determining our bias, there's that decision tree. If we think price is going to go up, is it going to go and take out buy side liquidity or buy stops at high prices? Or is it going to go up to take out an imbalance, a bearish fair value gap, and rebalance that imbalance? Or conversely, is price going to go down? Is it going to attack sell side liquidity and take out those sell stops? Or is it going to go lower to target a bullish fair value gap, an imbalance, and rebalance that imbalance? So that's the question that we're trying to answer as we sit down. And so if we use this particular example from the NASDAQ, we're on the 16th of February and we're looking at what will happen on the 17th of February. So if we just have a think about the state of the market and where we are. So the market's traded down, right down to this low here. And so if we run our fib from that low to this high here, so this is where this move started and this is where it obviously finished, you can see we have our discount and our premium zone here. So already the market's traded from a discount into a premium. It's consolidated a little bit, and as it's dropped back down into that discount zone, you can see it's created a fair value gap. And you'll remember from lots of other ICT teachings, he talks about that fair value gap appearing at that 50% mark fairly regularly, and that's again what it's done here. So we can see as the market's traded back down into a discount, it's traded back up into that fair value gap. On this particular move here on the 15th, it didn't quite fill it out, but it did so then on the 16th. You can see it completely traded both ends of that fair value gap and completely filled in that imbalance. And so from this point, the question we ask ourselves is, where do we think price is going to go? And that's going to help us to determine our bias. So on this daily chart, we have a fair value gap set up on the daily. So we have our 1, 2, 3 candle formation, and our fair value gaps form between the low of this candle and then the high of this third candle, obviously crossing the body of the second candle. And you can see this move has created this break in market structure, or this market structure shift right here. Now, if we're going to take that trade, our stop would be at the first candle, at the high of that first candle up here. And so at the moment, that trade would be active. And so using that logic, we've already had price trade back up. So if we were down here, we'd expect price to go up and rebalance that imbalance, which is what it's done. We've now had effectively our trigger created for entering this fair value gap entry here. You can see we've even got an order block entry just here. So if you were going off the body of this candle here, this would be one continuous order block. I'll just mark that up quickly. You could see you could use that even as an entry on this 1 day time frame as well. So we're expecting price to go lower because we've successfully triggered an entry on this bearish fair value gap set up on the daily chart. And so our expectation should be that price is going to go lower. And if we look to where it's going to go lower, we'd expect it to attack this sell side liquidity down here or these sell stops. And so therefore, going into the next session, we're expecting lower prices. We have a bearish bias. So you remember from earlier in the video, we talked about our bias as being the thread that sort of links all of our future actions together. So now as we move down into those lower timeframes, we want to continue to go with the flow. We want to use our bearish bias to help us look at market structure and then select trade setups that are all going with the flow. And we should be able to start to weave together a story that's either going to prove or disprove our hypothesis about what the bias is, and then help us to take trades or manage our trades accordingly. So zooming in now to our 1 hour chart, this is the chart that we're going to be using to frame our trade. Now keep in mind that all swings on this particular chart are still subordinate to our daily chart. As we start to dig deeper into market structure, we have our long-term highs and long-term lows, and they need to be anchored to something on the daily time frame. So in this example, we have our bearish fair value gap here in pink, this pink box, and that is transposed down from our daily chart. And that's where we have our anchor points for our long-term high and our long-term low. So we have a bearish bias, so we're expecting lower prices. And if we zoom out here, you can see the sell side liquidity that we're expecting to target down here. So remember, we're trying to weave a story, or we have a hypothesis about what we think the market's going to do, and that's in line with our bias. So we're expecting those lower prices. So it stands to reason then that our long-term high in this scenario can't be broken. So if we have the market trade above this long-term high, that would suggest to us that our hypothesis isn't right. We don't have the key ingredients for that story to be true. And so we'd have to wait and get more data, more price information from the market before we did anything else. And so that would prohibit us from entering a trade if we went above this long-term high. And equally, if we were already in a position and we went above that long-term high, we're going to either anticipate that our stop will get hit, or we may close that position out to try and minimize the loss on that particular trade. Equally, if that long-term low is broken, then we'd expect that we're really on the right track, that we've got the key ingredients for our story. Our hypothesis is more likely to be correct, and we're going to start working down towards those lower prices, down towards that sell side liquidity. And so if we look a little bit further towards the right-hand side of the chart, you can see we have more price action as we run into that end of the session on the 16th and we go into the 17th, where we obviously have our bearish bias. We have this bullish fair value gap set up occur here on this 1 hour chart. So our 3 candle formation here. So between the high of that first candle and the low of that third candle, we get that bullish fair value gap form here. And you can see we've broken this short-term high here, which is our market structure shift, or our break in market structure. And then we create this intermediate term high here. Now you may ask, why is that an intermediate term high? If you remember from earlier in the video, we talked about an intermediate term high having both a short-term high to the left and to the right of it, and that the high of that short-term high needed to be lower than the high of the intermediate term high. So remember, our short-term high is a swing high pattern, so it has a candle in the middle and one each side of it, and the middle candle needs to have a higher high than the ones either side. And so effectively, we're just replicating that pattern now in a sort of higher time frame, or at a different hierarchy, if you like. So we have the intermediate term high in between, and it's got the same swing high formation. So it's 3 candle formation, and the high of that center candle is higher than the ones either side. And then we have 2 other formations each side, so to the left and to the right, which are both short-term highs, both to the left and the right. And again, they have candles which the center candle is higher than the one either side. So that's what makes this an intermediate term high just here. Now you'll also remember from earlier in the video, we had 2 criteria, or 2 ways that a high or a low can be classified as an intermediate term high or an intermediate term low. And so the primary one, the more conventional one, I guess, is when you have a short-term high either side of it, like we do in this example. But the other example, and again, this is where ICT's market structure concepts deviate from the norm, is that when you have a fair value gap that gets filled in, like we do with these down close candles here, you can see the low of that candle completely fills in the imbalance, or this bullish fair value gap, as it comes down. Whenever that happens, that means we instantly have an intermediate term low. We don't need to have a short-term low either side. Just the filling in of that imbalance is enough to classify that as now an intermediate term low. So let's roll through a little bit more price action, and we'll start to see some more market structure, which we'll work through before we start looking at the setups that we could be taking on the back of that. So you can see now, as we've rolled forward a little bit more of that price action, we've actually had a bearish fair value gap set up occur on the way down here as well. So you can see we have our 3 candle formation, so 1, 2, 3, and our bearish fair value gap is formed between the low of that first candle and the high of that third candle there. So you can see as the market then trades back up, we get this sort of indecisive candle here, which trades up and down. And you can see at the high of that candle, it actually closes out, or it refills the imbalance of that bearish fair value gap here. And so again, just like we had down here, when we've filled in the imbalance here, that instantly makes this particular high an intermediate term high. So it doesn't actually have to have a short-term high either side of it that is lower. It just instantly is classified as an intermediate term high. So again, this is a key differentiator between ICT's market structure concepts and most of the other market structure concepts you'll hear taught. And so obviously this candle trades both up and down. It creates a short-term low here. And then as we trade back up again, you'll see we have this other short-term high created here. Now this is our area of interest, and we'll go into why that's an area of interest in the moment and why we're looking particularly in this zone. But first we'll go through a little bit more about the market structure that's played out and about why this particular market structure gives us confidence that our hypothesis about lower prices is correct and that we've got all those sort of key ingredients to our story, and about how we can now enter a trade with more confidence and hopefully with a higher probability of a profitable trade. So if we work our way through, you can see we have this long-term high and this long-term low. And as we move through, we get an intermediate term high, which is lower than this long-term high. So that's what we want to see. We don't want to see this intermediate term high go above this long-term high, because remember, if that does happen, if we have any highs that breach this long-term high, that means that our hypothesis is invalidated. We then have a short-term high, which is lower than this intermediate term high. And so again, that's what we would expect. And then we have an intermediate term low here, which is actually higher than this long-term low. So at the moment, we still don't really have enough information. Our highs are going in the direction that we'd anticipate, that we'd expect, but the lows are not. So the lows are also increasing. We obviously want to see these lows eventually get breached for our hypothesis to be correct. Now, as we roll forward again, we have this intermediate term high and this short-term low created by this particular candle. Now, the thing that's really important to note about this intermediate term high is that in a classic definition of an intermediate term high, it should have a short-term high and a short-term high either side of it, which are both lower. Now, in this case, we don't have that. What we have is a short-term high, which is higher than the intermediate term low. And remember, this intermediate term low has been created because we filled in this imbalance just here. So already that's an indicator to us that the market structure is breaking to the downside and that we have more confidence that our hypothesis is going to be correct. And on the lows, you can see our intermediate term low here. We have a short-term low to the right and to the left. And so again, that's what we'd expect. But also, because this particular move rebalanced this imbalance, it's instantly classified as an intermediate term low anyway. If we move further to the right, we have another short-term high formed, which is lower than this intermediate term high. So we now have quite a lot of evidence showing that the market is about to break lower. We have a long-term high, an intermediate term high, which is lower than that high. We have a short-term high, which is lower than this intermediate term high. We have an intermediate term high, which is lower than that particular intermediate term high. And we also have this intermediate term high, which is lower than this short-term high. And that's a really critical point. And then that this short-term high is lower than this intermediate term high. And so now why is this particular area an area of interest? So remember, we have our bearish fair value gap here. And so if we extend that out on this 1 hour time frame, we know that this is an area of interest because that's falling right back into our bearish fair value gap. And so once that setup is triggered, which it is by this particular move, we'd expect price to go lower. So that's one of the things that's confirming. And obviously, if we're taking this trade on the 1 hour chart, our stop would be up here at the high of this candle, because that high is higher on the second candle than it is on the first. So I can just quickly mark that up. And so we'd expect price to go down now that we've hit that bearish fair value gap. We also have this market structure tipping its hand to us that we're expecting lower prices. So if we look in this yellow box here, what we actually have is an order block here. So we have these two consecutive candles. Now we're using this candle and not this one because the low of this candle is lower than this one. So on this 1 hour chart now, we have this area of interest and we have a bearish fair value gap here, which overlaps this particular price action and also overlaps this order block that we have here. So this is why this is an area of interest for us. And so as we go into these lower time frames, remember, we're going to be carrying our bias into those lower time frames. We have confluence with multiple setups on the 1 hour. And so as we go into those lower time frames, if we're finding setups that then match our bias, that's going to increase the confluence and should most likely increase the probability that we're going to have a successful trade. We're going to have all the components that we need to complete the story. So now we've moved into the 15-minute chart, which is our bellwether chart. Now, one of the things to just keep in mind before we go any further is that we don't replot this market structure that we put on the 1 hour chart back onto the 15-minute chart. There's no need to do that. That's just overkill. We can still use those plots, these long-term highs, intermediate term highs, and so on from the 1 hour chart on our 15-minute chart. And so from this point, we continue our bias, our bearish bias, as we go down through the time frame. So we've gone from daily to hourly to now the 15-minute chart, and we're continuing to look for bearish setups because that's the direction of our bias. So we're going with the flow of our bias. So now that we've gone through the process of framing our trade, we're now on the 15-minute chart looking for setups. It's a good time to run our fib from the low. So we're going to use this long-term low to this intermediate term high. So the reason why we're using this move to this move rather than from the long-term high to this long-term low is that this move up is the one that starts what we're assuming is going to be the move downwards. So that's why we use this long-term low to this intermediate term high here. So you can see between our fib, we've got our discount and our premium zone. And obviously, if we're wanting to go short, we want to be doing that in that premium zone, ideally. And so that's going to be above this 50% mark. And you'll remember from lots of our other lessons is that we often find fair value gaps at that 50% mark. And if you just run your eye across that, you can see there's one here. There's one just slightly above it here. There's another one here, and then these two here. So again, we find that by using this fib, using our 50% mark, it's a pretty easy way to find those fair value gaps in this range. Now, one of the other things we're looking at, we have a hypothesis, part of our story is that we're going to trade down lower and we're going to take out the sell side liquidity that's down here. So if we zoom out a bit, you can see this sell side liquidity residing down here. So this is where we're anticipating that price is going to go. And one of the things we can do to, confirm that, or one of the things we can do to reinforce that hypothesis is we can use our fib, and this time with a 1.5 standard deviation, just as a generic guide to just try and build some more confluence that this sell side liquidity target we have down here is a reasonable one. So you can see I've done that. So I've got a fib that goes from 0 to 1 here and then down to 1.5 standard deviations below this low here. And you can see that actually then resides below this sell side liquidity. So that's just giving us a little bit more confluence that this sell side liquidity target is a reasonable one. And so we can now start to look for setups to try and achieve that target. So if we zoom back into our 15-minute chart, you can see we've got this pink box here, which is that bearish fair value gap we have from the 1 hour chart, which is now being transposed down onto this 15-minute chart. So we've got this confluence that we're starting to build. We have this fair value gap, the bearish one from the daily. We now have one from the hourly, and there's also these fair value gap setups that we have here now on the 15-minute chart. Now, one of the things I just noticed whilst I was drawing this up before is there's actually another fair value gap here on the 15-minute chart, which overlaps again with these ones that we've already marked out. So I'll just mark that up there, and you can see the confluence we're building around this area of interest here. So this gold box, this area of interest, is this order block that we have here, these consecutive up-close candles. And so we have both fair value gaps and now these order block to give us confluence in this region that this is somewhere where we can be going short. So if we used this first fair value gap set up here, and this isn't in ICT's video, but it's one that I picked up whilst looking at it myself, is you can see that we have the 3 candle formation. So we have 1, 2, 3 candles here. You can see we broke market structure, and the fair value gaps formed here between the low of that first candle and the high of that third candle. And if we run that across, you can see the market trades back up into that zone. We have this sort of golden pocket, if you like, that we trade into, this area of interest that we're looking at before the market trades lower. And so if we'd used this bearish fair value gap setup to go short, then our stop would have been just up here at the high. So you remember from the 1 hourly chart, we'd already marked that there was a bearish fair value gap set up for this 1 hour setup here, this bearish fair value gap that we have here, and that would have been the stop for that particular setup. So now on the 15-minute chart, using this bearish fair value gap setup, we now have this particular stop here at this high. So we obviously wouldn't want price to go above this point because that would invalidate our setup. Now, like this one that I've marked out here, that would be an aggressive entry because we actually haven't had this short-term high form yet. So we would be going into this position on the basis of this intermediate term high, which would obviously be a more aggressive entry. But again, we would be up in this premium zone, which is where we want to be. But now going back to our area of interest, this golden box here, we have this consecutive up close candles, which is our order block. And we have another bearish fair value gap set up occur just here. Now you'll notice this isn't the traditional fair value gap setup because we don't have a break or a shift in market structure. There's no breach of a short-term low in here. Because there's an order block, we don't need to have that short-term low breach. We don't need to have that shift in market structure. So we can enter into this bearish fair value gap setup on the basis that it sits inside an order block. So remember, this is the order block from that 1 hourly chart that we marked out earlier. Now, the other thing that would give us confluence on this particular entry is you can see is if we run the fair value gap from that earlier setup across to this one, so they overlap. So we now have that confluence of this particular zone here. You can see that this entry into here is going to give us more confidence because we have that overlapping fair value gaps there. Now, if we weren't confident in taking that setup, we have this much lower risk formation happen here. So you can see our 3 candles set up here, 1, 2, and 3, and the fair value gap setup occurs between the low of that first candle and the high of the third candle. So you can see that here, and you can see that the market trades right up into that before it goes down. Now, the other way of entering this particular fair value gap would have been to use the edge of this order block here. So you can see if we'd use that, I'll just change that color to make it a bit easier to see. If we'd use that as our limit, you can see the market would have traded up, and that would have given us a much tighter entry because we obviously would have had our stop sitting up here at the top of this candle just here. And so this would have been a much lower risk entry because obviously we've had all of this market structure formation occur. We've got this short-term high. We've already seen the market trade through these bearish fair value gaps that are up here higher and now trade into this zone here, which is giving us that lower risk entry. We're obviously giving up a little bit of that potential greater reward because we'd be going short inside this discount zone rather than in the premium zone, but this is a much lower risk entry. So if we just roll through just an extra couple of bars of price action, we can start to summarize our story or confirm our hypothesis about this whole trade. So you'll remember we started with the daily time frame and we had ascertained that we had a bearish bias based on that price action and the market structure that we could see on the daily chart. So we were expecting lower prices. Then when we came down into the 1 hour time frame, we were using that to frame our trade, and we were anchoring this fair value gap using the long-term high and the long-term low to the daily chart. From that 1 hourly chart, we were then able to map out our market structure and use that as a way of confirming that price was moving in the direction that we wanted to. So you'll remember from that 1 hourly chart, we knew that if price went above this long-term high, that invalidated our hypothesis. It would mean that, we were expecting price to go lower, but by breaching this high, it would mean that it wasn't going to be going lower, and we'd have to wait for more price action to determine where the market was going to go. But we didn't get that. We had this intermediate term high, which was lower than this long-term high. We then had the short-term highs form here. So we had a very standard or traditional intermediate term high formation just here. We then had that followed by a bearish fair value gap, which was formed here, and that instantly made this particular high an intermediate term high. So we now had an intermediate term high, which was lower than this intermediate term high, but this intermediate term high was lower than this short-term high. We then had this short-term high form, so we now have this very particular setup where we have a short-term high, which is higher than this intermediate term high, and this short-term high, which is lower than this intermediate term high. So that's all giving us a clear indication that price should go lower and we can expect lower price. So then when we zoom into our 15-minute chart, we're then looking for setups to take advantage of this bias. Remember, we're continuing to go with the flow. So we're looking for more bearish setups on our 15-minute time frame, which we do. So we now have these overlapping areas of both fair value gaps. So we have 1, 2 here. We also have an order block, which we've transposed down from the 1 hour chart onto this 15-minute chart. So we've created this important area of interest, which coincides with this short-term high. So this is really like an inflection point. It's this area here where we choose to take a short position to take advantage of all the confluence that we've just built up based on our hypothesis. So what we're looking for now is for price to start breaking key points to continue our story or to continue to validate our hypothesis. So you can see price comes down into this zone here and we take out these short-term lows. So that's the first positive indicator that the market's going in the direction we want, that it's starting to validate our hypothesis. As we go through this intermediate term low here, you can see the market starts to accelerate. So we're creating these fair value gaps or imbalances as the market starts to trade lower. And then you can see as we take out this long-term low, so this is obviously a really critical part of our hypothesis, because we know that once we take out this long-term low, that we're really going in the right direction and that the trade's going where we want it to be going. So at the moment, we have a much higher confidence that we're now on the right side of this trade, and it's now about using the price action to manage the trade all the way to our target, to complete our story and confirm our hypothesis to be correct or incorrect. Now that we're in our trade, it's all about managing our exit. So are we going to look to scale out? Where are we going to take profits? And we can again look to the price action to give us an indication about where the market's going to go and whether we're still going to hit that sell side liquidity or that 1.5 standard deviation Fibonacci target that we set earlier in the video. So if you look at this price action here, what we can see is as the market's traveling downwards, predominantly the candles are all dark. So my down candles, my down close candles are all black. And so you can see it's predominantly black. Now, when there are up close candles, which I have hollow or they're white, these actually form like little speed bumps for price. So you can see as the market comes down, it hits this block of up close candles, and that creates like a little speed bump for price before it starts to travel down again. You can see we get another little block of up close candles, but these highs never go above these highs. We just get intermittently an up close candle in this process downwards. And you can see as we continue to trade downwards, it's predominantly down close candles. We've predominantly got these black candles just interspersed every now and then with a single up close candle. And you can see how looking at price action in this way helps us to stay in the trade, even when it looks like it may be going against us. So you can see after we have these consecutive down close candles in this big move, we have this consolidation period before this race up here. But you'll remember these little up close candles, these little speed bumps, as long as we don't continue above those, then we can stay confident that the market is going to go in the direction that we want it to, which is obviously downwards. So you can see even with this race up, we have this little consolidation. Again, we have these block of up close candles, which creates these little speed bumps before the market starts to trade down lower again. Now, if we keep moving forward and look at the remaining price action, you can see after this little period of consolidation, we get a continuation of that move. And you can see how price really attacks that sell side liquidity and then goes right down to that 1.5 standard deviation down from our long-term low. So keep in mind in this area of interest, you could continue to zoom in closer. So if you're looking for a better risk reward, you could zoom down to, your 5 all the way down to your 1 minute chart inside this area of interest here if you wanted to get a tighter entry and a better risk reward. But you can see even from these entries here, these would have been really high risk reward trades. So if we look at from that first fair value gap that we outlined, this was the one that wasn't in ICT's video, but that I found here. So if we assume our entry was around here somewhere, if we go down to that sell side liquidity target, that's an 8R return. And if we go down to the 1.5 standard deviation, that's over a 9R return. So that's a pretty amazing trade just there. If we were looking at this more aggressive entry that we had here, that's going to be almost a 10R return or almost an 11R return if we go down to that 1.5 standard deviation mark. And even this less aggressive entry that we had down here, assuming we were using that order block entry, that makes it a bit of a tighter entry here. Again, we're looking at a 15R return or a 16R return or 16.5R return. And if we didn't use the order block entry, it would obviously be a little bit higher risk. But even so, it's going to be an 8R return at that sell side liquidity or down to almost a 9R return if we go to that 1.5 standard deviation mark. So there you go. There's my review of Lesson 12 of ICT's 2022 YouTube Mentorship Program. There's been a lot of thinking and revising that went into making this video. So I hope I captured all of the concepts from ICT's lesson, and I hope that my reconfiguration or my review of that lesson really helped you to consolidate some of your learnings. So I think there's 3 big takeaways from this particular lesson. And the first is that your bias is like a thread, which connects all of the various time frames that you're using to, do your analysis, to frame your trade, and then to obviously execute your trade. And then the second is that we're going to use the 1-hour chart as a means of framing our trade before we start to zoom into those lower time frames. And lastly, that we're going to identify intermediate term lows and intermediate term highs by filling in imbalances or bearish or bullish fair value gaps. Just as a final note, so one of the things that started to formulate as I was doing this video was this idea to look at the whole process of, looking for trades and setups and so on as just a hypothesis. So going through right from my bias all the way to execution was that it was a hypothesis. And so each step of the way, I'm just looking at either confirming or disproving that hypothesis. And so looking at the whole process in terms of I just have this theory rather than am I going to be right or am I going to be wrong, I just found to be a much more positive way of looking at the whole process and kind of detaching from making it this sort of personal thing of did I get it right or did I get it wrong? So I just found that a much more positive way of thinking about the whole process. So I hope you enjoyed this video. If you did, it would be great if you could like it because that helps other people to find it. And if you'd like to see more videos like this, make sure you subscribe to my channel and turn notifications on. Thanks for watching, and I'll see you in the next video.